So interest rates are going up, and a lot of index universal life agents are assuming that because interest rates are going up and the general funds in the life insurance companies are going to be performing better, therefore cap rates will start to increase as well. Well, nothing could be further from the truth. And in this video, I interview Bobby Samuelson, and we talk about the fact that there's not a direct correlation to increased interest rate environment and increased cap rates and performance inside of IULs. Talk about why that is, how it all happens, what the potential 3 to 5 year outlook is, and why you need to actually think way longer than that if you're going to be putting your money inside of an IUL contract or even selling them. You need to understand all the possible ramifications. So, looking forward to getting into this with you and sharing it with you. But if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Make sure you check out the Index Universal Life training playlist at the end of this video. It will benefit your business. Let's get into it. All right, well, let's move on here. What are your thoughts on this question? What do you see as a 3 to 5 year outlook for cap rates? Because, and let me elaborate a little bit. I'm getting a lot of questions, a lot of comments saying, hey, cap rates are going to go up. This is something that somebody that I'm in kind of a spat with right now about IULs. He's saying that his company is going to raise cap rates and that they can predictably do so because interest rates are going up. So the options budget's going to go up and all these things. What is kind of your perspective on how cap rates, par rates, spread charges, all these things are going to be impacted based on the increasing interest rate environment?
All right, I'm going to leave par and spread off to the side.
Okay.
You can't have a long-term perspective on par and spread because par and spread is so volatility dependent, and so that's a month-to-month sort of thing. Caps are a different animal. So I think in terms of sort of the core theory, here's what's going on. The price of a 10% cap in 2014 was 3.9%. That's how much it costs for a life insurance company to hedge a 10% cap, 3.9%. So to convert that, all a carrier has to earn on its assets is 3.9% in order to be able to offer a 10% cap. Today, like right now, the price of that option last week was 5.1%. So what's happening is, yes, interest rates are going up, but interest rates are an input into option prices. And so over the last year, interest rates have steadily marched up, and so have the price of options, or so has the price of options. And so therefore, that's why caps are kind of staying stable. So however, what we're starting to see is sort of a divergence, right? Some companies going this way and some companies. So if you think about it, in a falling rate environment, the best situation you can have as an insurance company is a big portfolio invested in old assets with low turnover. And that way you can hang on to your high yield assets for longer and keep your portfolio rate higher than your new money rates. In a scenario where new money is higher than portfolio rates, what you want is to be a company that's selling a lot of new business, and has sold a lot of new business very recently, so that you have a small block that's getting a lot of new money coming in, and therefore your yield can rise faster with new money rates. So what we're seeing right now is a split in the marketplace where you've got a lot of established companies like Pac Life, for example, that sold a lot of business in 2014, 15, 16, 17 at much lower rates. They're keeping caps low. And then you're seeing companies like Allianz who are increasing their caps, who really didn't sell a lot of business until 3 or 4 years ago, 2-3 years ago. Small block, a lot of recurring premiums, a lot of new business coming in, and boom, you're getting them kind of catching up to more quickly to new money rates. So I think you're kind of seeing a little bit of a split in the market. I think if you were to make a generalization, I'd say I think caps are going to continue to stay pretty much where they are right now for any big established company. And if caps are high or increasing, it's because it's a smaller company with a smaller portfolio, and they're basically blending faster into new money. But I don't think, but here's the thing, right? That cuts, again, both directions. So if rates come back down, right, that will burn off quickly. So there's just a lot of dynamics there. And I don't think, here's what I hear IUL people saying. I hear the same thing that I hear you. Rates go up, caps will go up. Only if option prices don't go up. And option prices have gone up. Option prices have gone up faster than carrier portfolio yields have gone up, which is why carriers dropped caps last year and dropped caps into this year. And so that's I'm sorry, and 2022 and then into 2023, they're not increasing them. So I just don't think you can generalize. I think every carrier is going to have kind of a different path. And so now if you stretch out 3 to 5 years, eventually those new money rates will come up. As long as option prices don't continue to go up, caps should go up a little bit, but we're talking about 25, 50 basis points. We're not talking about going back up to 12%. And I think that's the kind of gap everybody has in their head is, oh, it's going to go back up to 12. No, it's not. It's going to take a long time. It took a long time to come down. It's going to take a long time to come back up.
Well, so when you look at it, another kind of off the cuff question here. When you look at an IUL, and let these companies that are illustrating at 6.5% assumed performance or whatever, what do you think is actually the realistic crediting rate going into a policy net of all fees, cost of insurance? Is it like 4.5, 5.5? Like, what do you see across the board?
When you illustrate 6, what you actually see in terms of rate of return in the policy?
Yeah. Like what's the good long-term? Because like, I get kind of annoyed with, agents being like, oh, you're buying this for the long term. You got to think long term, but then they only sell on the like 2 to 3 year window. Like, this is what they're going to do today. No, let's look at the whole picture long term. Like, what do you really see as a realistic?
I continue to say that I think over the long run, IUL is going to perform like a UL generally. And so corporate bond type returns. And right now, corporate bonds are pretty good, 5.5%. So I think if today's interest rate environment stays, 5% is probably good. But again, that's based on today's rate environment. So I tend to look at it as forget the look back, forget what the carrier is showing you, look at today's corporate bonds, and that's probably what it's going to be. Now, the yield curve's inverted, rates could come back down. So the main thing is don't worry so much about how it illustrates. Like, why are you even, whatever you illustrate is going to be wrong. We can all agree on that. And so the question is just, how wrong do you want to be and in which direction? And the lower you set the illustrated rate for the sale, the more likely it is you're going to outperform. And that seems like a reasonable thing to do. But it doesn't sell well. And so people tend to go the other direction where they maximize it, and then they give themselves all this situation, all these fact patterns that hurt the yield or hurt the rate. So I just say, look, I don't get why people are so worked up about this. Like, for my entire career, people have been asking me, what's the right illustrated rate for IUL? And there is no right illustrated rate. All illustrated rates are wrong.
Yep.
The question is just how you want to manage that risk. That's it.
Right. I always kind of say, like, use common sense. Like, if the insurance company had the ability to get you 6.5% predictably safe, whatever, they'd figure out a way to do that for themselves.
Yeah. Right.
Right. I mean, like, if you just break it down and eliminate all the noise, all the minutia, and just think commonsensically, like, that's a pretty easy way to kind of look at it.
Well, yeah, there's some funny sort of technical elements to that argument, but I think that's a good kind of BS line to draw.
Yeah, exactly. That's kind of how. Hey, what's up, Cashflow hackers? So I hope you got value out of this video. There's a lot of nuances when it comes to setting expectations and understanding, like, how do these things actually work. And I think when we break it down, because of the tactics that go into creating illustrations, how the life insurance companies do these sorts of things, I think it's important that you utilize a lot of common sense on how this all comes together. And, we touched on it at the end of the video here, right? Like, if the insurance company can't get 6.5% for them, 6%, even 5.5% in their general account portfolio, how do you expect that they're going to be able to do that and get it for you? If they could do it for you, and do it predictably and safe, they do it for themselves. So once again, hopefully you found value in this video. Make sure you check out the training list right here, and make sure you also check out this video. I think it's going to help you continue the journey, continue the education, do the deep dive, whether you're looking to learn more, to learn how to sell it better, or whether you're looking to purchase a policy. If you haven't already, make sure to check out the link to the life product review down below as well. I would go check that out. And subscribe. If it will make a massive impact in what you're doing if you're looking to utilize IUL in your life in any way. So that's it. Have a blessed, inspirational day. We'll talk soon. See ya.